Is PayPal stock an easy double from here? The stock is up around 11% after they reported their second quarter 2022 results, and partly because there was low expectations about inflation fears, inflation pain. I've called this out previously, which is that as you have inflation with items like food, energy, shelter, folks have less money to spend on, let's say, everything else. And PayPal's wallet share of all those items that are core to inflation is generally lower than, let's say, e-commerce. And so they had been feeling the pinch especially hard. And so the question was like, well, how bad would it be? And this quarter results reflected that they continued to post up very reasonable growth figures, where you saw a total payment volume of 9%. After you adjust for the strong US dollar, is closer to 13%. Their net revenue, which is effectively tied to their payment volume, up 9%. So this is still very strong, very reasonable, still taking market share. There were three big developments here that I like to see. One is the new CFO making sure, hey, this ship is going to get steered in the right direction, hopefully. That is a very important role to fill with the CFO role. Also, the $15 billion share repurchase, that's management saying, yeah, we think the stock is cheap. It's time to make a big bet on the stock. That's a couple of years of their free cash flow looking to effectively up their buyback. Now, curious to see how quickly they actually deploy that. How much debt do they potentially use to do that if they're looking to do it quickly? They also talked about entering into an information sharing agreement with Elliott. This is actually potentially really important. It does have an impact on the stock and how investors can think about the valuation. I personally am raising how much I think about what the upside potential can be, because when you have an outside investor, even if they're not a controlling investor, but if you have an outside investor that will potentially write, let's say, nasty grams and make it very public, writing letters saying, hey, Dan Schulman or the board, you guys are doing a piss poor job. You're missing expectations. If that sort of is over your head, like sort of Damocles, is that it? If you have that over your head, you're going to make sure like, oh, I'm going to do everything I can to execute. And so I like having that sort of pressure where they're saying, oh yeah, we're going to work with this investment firm to make sure things are right. And so the reason why that gets to a slightly higher valuation, I'll show more of the details a bit later, is because then you start thinking, okay, they are going to be a little bit more ruthless on their cost structure. Let me talk a little bit more about that aspect in just a second. And so looking at one of the core value drivers of what effectively makes PayPal a very strong business is their number of active accounts. And you see that their number of active accounts, while it was flat quarter over quarter, 429 million in the second quarter of 2022, it was still up year over year. And critically, even quarter over quarter, the number of transactions per account are still going up. And this is the reason why this is so important, is as people continue to transact using their various different PayPal digital wallets, this means that merchants need to continue offering PayPal as one of the payment solutions. So this means as long as consumers love it, merchants are going to be forced to effectively say, hey, we need to accept their solution. So that is an important aspect. But I did talk about in greater length, I haven't really covered it here, there's some nuances around their profit profile and their margins. And you can see that over time, let's say since the first quarter 2020 through the second quarter 2022, their profit margin, first quarter 20 was impacted by COVID. So really better to look at the second quarter 20. You could see that their operating margins have been declining significantly over time. It may not look like it because there's effectively a crime chart going on over here, but dropping from 18% to 11% is quite sizable, 28% to 19%. It sort of looks flatter than it actually is. That is a big drop in core profitability, this operating margin. And once again, I talk about that more in my letter, talking about the PayPal, wallet versus the Braintree services that PayPal provides, and saying, hey, this is a structural challenge that they're facing. Now, you might say, well, wait a second, Daniel, their free cash flow is up 22%. So why am I so worried about the structurally declining margins that I was just talking about here? If PayPal has better margins than Braintree, and they've losing effectively their PayPal business because eBay switched to Adyen and Braintree is the one that's picking up the share, and this is structurally low margins. Is that such a big deal when free cash flow is up? Free cash flow is up 20% this most recent quarter to $1.3 billion. Well, hold on a second. like, let's actually look at what's going on with free cash flow. This is the reason why you always have to do the work, versus just it's trust but verify. If management says, oh yeah, our free cash flow is looking great, it's up 20% this quarter. It's like, well, wait a second. Let me see what's actually going on here a bit. Because when you look at it, and if you remove working capital, and the working capital changes on a like for like basis. So last year versus, versus this year, and remove any sort of hindrance or benefit from working capital, and their free cash flow or their operating cash flow was actually down 28% year over year. And then when you look at it on the 6-month basis, you actually see that once again, they were down year over year. And this is actually operating cash flow without even looking at the changes in working capital. Once you exclude the changes in working capital, it's similarly down something like 25%. But their core free cash flow is declining year over year. I mean, that's what you're seeing with sort of the crux of the business. And that gets back to my point of like, this is concerning to see that their core operating profile, their core operating margins have been heading significantly in the wrong direction, partly because of these structural challenges that I called out in my investment letter to Unrivaled Investing subscribers. Now, this is why management, Dan Schulman, quickly was like, oh, yeah. We appreciate the partnership with Elliott Investment Management. We're both looking to maximize shareholder value. And oh, by the way, yeah, we're announcing this $900 million of cost savings in 2022, i.e. going to be firing a bunch of people. And $1.3 billion that we're going to be saving next year. So like, yeah, it's going to be even better, even bigger cuts. And yeah, we're going to announce this mega share buyback. So that way, don't worry, Elliot, we've got this covered. You don't have to worry about writing some nasty letter and trying to kick me out of my job. Like, oh, we're going to do what it takes. Don't worry. And this sort of seems like a reactionary approach. It's like, wait a second, this has been going on for some time. Like, let's actually try to figure out these margins and try to improve them, or at least call it out. So let's go back to that question of, is this an easy double from here? First, if you're struggling with this investment environment, consider unrivaledinvesting.com for new ideas and a community of like-minded investors. Also, in full disclosure, this is not financial advice. And so looking at it once again, structurally, you can see it a lot of different ways. Their core transaction margin is heading steadily lower over time. And you can see that quarter after quarter after quarter. Here's June 2021 versus June 2022. Heading lower, their core profitability. Once again, that's why management announced this $900 million in savings. Now, I do like to see this sort of language saying, hey, it will result in operating margin expansion next year. So they're sort of hoping to reverse sort of the perpetual parade down, heading lower, saying, yeah, that's going to it's going to reverse course next year. So maybe you go from, let's say, 11% operating margins or low teens to mid-teens to high teens next year, which would be, the right direction that we'd want to see. But looking at their gross margins, not their operating margins, their gross margins, this isn't just a one-off event. This isn't just coming off of COVID. You can see over, let's say, the last decade that their core gross margins have been coming under pressure over time. In the most recent quarter, it was closer to around 40%. So you can see this has been a structural challenge. Now, they've looked for other growth drivers with other services. Once again, I talk about that in my investment letter to Unrivaled Investing subscribers. But core, look under the hood, and you do see some gross margin pressure. Now, as I mentioned earlier, having a relationship with Elliott, even if they're not a controlling shareholder, puts the feet to the fire for management, saying, hey, let me think about what their margins could be. In thinking about, it's not here now, so it's going to require those cost cutting. It's going to require, I'd argue, maybe more of a wartime CEO. So maybe you might need to see a change in management. We'll see. Where it's effectively saying, yeah, we need to make sure our margins can be where they can be. And I'm looking at this thinking, if you want to value and think that if you're aiming for, let's say, a double, you're going to need to say that their operating margins could be much higher than where they were this quarter and this year. Maybe 15 to 20% operating margins. 20% is closer to a double versus where they are right now. And then the question is, well, can they reinvigorate growth at the same time that they're cutting costs? That is a tough situation because currently they're growing at 9%. Now, admittedly, if the economy starts changing a bit and they have less inflationary pressure from effectively people being able to spend more on e-commerce versus, let's say, oil and gas, then you might be able to accelerate their growth. So that's not necessarily in their hands, but assuming a range of growth, 9 to 15% annualized growth in the years ahead, this is a big question of how this sort of shakes out this year, or excuse me, in the coming years. And then what's the appropriate multiple for this business? I'm assuming around a 20 times earnings multiple 5 years out. That's not this year. This is assuming 5 years out, it gets a 20 times earning multiple. And in the high case scenario, assuming lots of cash flow is returned to shareholders, effectively 5% annual yield returned to shareholders, and management's making it very clear with that $15 billion announcement saying, hey, we're going to be returning the higher end. So that does suggest, you over a 5-year time frame, maybe you are getting that 5-6% maybe annualized cash flow to shareholders. In that scenario, it is possible, assuming this growth, assuming significant margin expansion, and assuming a low 20s earnings multiple and lots of cash flow return to shareholders, then I could see a situation where the stock a little more than doubles over the next 5 years. If you do not see, let's say, 15% growth and 20% margins over the next 5 years, or at least it's not valued as such, then I think the returns will be a bit tougher. So that is, that's how I'm currently looking at PayPal. I look at PayPal as an exceptional business, but it is kind of going through a turnaround. I mean, that sure is what it looks like, where you're talking about removing $1 billion worth of costs from their core operating business model. You look at this steadily heading down gross margins. I mean, this is them saying, oh yeah, we're going to change, we're going to turn around our operating margins. So this isn't just a great compounder, at a compelling price. I'd say this is actually somewhat of a turnaround story at this point. And will Elliott have to apply more pressure? When I previously was looking at my valuation here, I assumed, let's say, a range of 13 to 17%, which gets a much, sort of even worse sort of upside downside. And keep in mind, this is a hypothetical valuation framework. This assumes like, hey, what am I playing for? What this is how, if they execute. If management doesn't execute and the business stays with their current margins, that's lower than 15%. So that would be lower than this low side. This is assuming good execution and a range of what sentiment could look like. Sentiment could be even worse. Sentiment could be even better for what, the business could look like. So this is, it is important to call that aspect out. There is some dynamics here, but this is a hypothetical valuation framework. Stock price can go way higher, way lower. But I previously, at least when I was talking about it with my Unrivaled Investing subscribers, I was using a bit of a lower framework, partly because I was thinking, man, who's going to keep management in check? So seeing them, management saying, oh yeah, we're doing this, some sort of shared information with Elliott. We're listening to Elliott. We have mutually, we have the same mutual goals of maximizing shareholder value. They're saying, oh, okay, like we want to keep our jobs. That's really what's going on there. And so the odds that they're able to get those higher margins are there, but it's still going to be a tough slog. So I'm going to take this, one quarter at a time and see how they deliver. Are they going to be able to reinvigorate sales? Are they going to be able to turn around their profit margins? Let's see. Let's see how this investment journey plays out. Sometimes you can buy stocks where you're already looking at the turnaround happening. The growth is there, the profit margin expansion is there, but the stock still trades at, a very low multiple. That is a sort of a lower risk situation. That's personally what I would be looking for. And also, looking at this hypothetical valuation framework, I would personally look for better setups where it's, just much more compelling upside. In this environment, I'm personally preferring situations where it's like, oh yeah, on the upside, maybe I'm looking at 300% upside versus saying, oh yeah, maybe it could double, if all this stuff works out. So I'm not quite pulling the trigger here. If you have a different opinion on PayPal, I'd love to hear it, especially if it's opinion based on saying, hey, Daniel, I have high conviction that 20% margins are no problem because, and I'd love to read that comment in the description, or why 15% growth over time over the next 5 years, which is way faster than they're currently growing, will be achieved. So I definitely want to hear feedback, especially if you think I'm wrong or you're a mega PayPal bull. So I have looked at this one quarter at a time saying, hey, I would like to buy this company. It meets a lot of the check marks of what I want to buy. The low capital intensity, high return on investment capital, this potential for, long-term growth, capital being returned to shareholders, huge buybacks. I mean, a lot of these things that I like to see, but there are some sort of secular or structural challenges that they clearly are facing. And I want to sort of see how that plays out. And I'd rather have that as a tailwind than a headwind when I personally consider buying it. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. And thank you so much for watching Unrivaled Investing.